Good morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Demetri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show is all our shows for informational purposes only concerning Market Chameleon tools and products. With that, D, good last day of the year morning, my friend.
Yeah, good morning, Will, and good morning to everyone. Um, let's start out with sharing my screen here. And what we'll do today is take a look at an implied volatility chart, see what type of insights we could get from implied volatility chart, and some of the features and tools that we could use to answer different questions. So to get to one, we're going to use a stock. So let's use Nvidia. In our example, I'm going to type in Nvidia up top over here to go to Nvidia's page. You'll end up in this summary page. And on the left-hand side, you have this menu. We're going to go to options. And actually, I think it might be under volatility. Sorry. So under volatility, we'll click on implied volatility, and it's going to take us to this implied volatility chart for NVIDIA. I'm going to close this menu on the left-hand side to expand our screen. And let's first discuss what this initial line chart means. Because when we talk about implied volatility of a stock, in this case Nvidia, we have to define what that benchmark is looking at, because unlike a stock, implied volatility is something that's derived from option prices. So there's no such thing as, Nvidia implied volatility or Apple implied volatility. It's something that we derive, we calculate on using an option pricing model. So we take inputs, option prices, put it into a model, and we get this implied volatility. So which option do you put in? Nvidia has lots of different options. They have different expirations. We have calls, we have puts, we have bids, we have offers. We need an option price. We have different strikes, and if you put two different options in, you'll get two different implied volatilities. So we need some kind of stable benchmark that we could track, because we want to see the changes, and what are the historical averages and high and low. So we need to we need an option that has a constant maturity, right? So we can't look at an option that's 7 days to maturity, and then the next day 10 days, and the next day 30 days, and compare those volatilities, because they'll be different. So we need an option with a constant maturity, and we need an option with a constant strike or distance from the spot price. And to do that, we have to create this benchmark. And in this situation, we're looking at a 30-day at the money constant maturity. And to do that, we need a methodology to figure out, a 30-day. What's a 30-day option? Well, since we don't get a new one every day, we have to create a formula or a model that takes the weighted average of the options that straddle 30 days and recalculate it every day. And we need a way to figure out an at-the-money option using the weighted average of the strikes surrounding the spot price. So when we do that, we came up with this model similar like VIX. VIX is doing the same thing. Then we could track the implied volatility level, and then we could see the changes. Where is it now versus yesterday or the day before or a week before? What was the high of the year, the low of the year? How does it change during earnings and so forth? So that's what this chart is doing, is looking at a 30-day at the money implied volatility. And the initial chart lets us see how that implied volatility looked like in the last year. We could go back further by using these tabs, okay? And in the last year, we could see, how high it got, looks like up here, got up in the 88 range, the low, I don't know, maybe down here in 33, 30, maybe, yeah, around 33. We also have these indicators, the E, which is an earnings. So we could see that, leading up to earnings, the implied volatility starts to rise, and then there's a sharp decline after earnings are reported. So that gives us a visual of its trends, how it behaved. These bars over here represent the option volume. These are the option traded volumes. So you could see kind of in Nvidia, certainly throughout the year, as it's gotten more and more news, the volume has visually it's been increasing. It's the later half of the year is much higher than the start of the year. So that would be our starting point. Then we could come here and we see like that the last implied volatility is probably somewhere in the middle of the high, low, and maybe around the long-term average. And to get more insights, we could start overlaying this line chart with other lines to give us a little bit more perspective what's going on. And if we wanted to see, is the implied volatility currently trending higher or lower, sometimes it's a little bit hard to spot just eyeballing it unless you have like a straight line going up or down. So we could overlay this with a 20-day moving average. So 20-day moving average compared to the most recent will let us know, are we going above that or below that? That's how we kind of look at, we could use moving averages to detect, which way it's trending. And that's what this tab is over here. So if we click on the 20-day moving average, now we have two lines here. And the red line is the 20-day moving average implied volatility. The green line here is the most current. And we could see here that so far, it looks like in a 20 days, a little bit more smoothed out, right? Because it's averaged out. So it looks a little bit smoother. And it looks like, it's been trending down since earnings and now leveled off in the 20-day moving average. Might be ticking up a little bit. And the current implied volatility, you could see it bounced above the 20-day moving average, kind of came back down to it and sits a little bit above. So if we were looking at it as like a support resistance, it's probably right at its, close to its 20-day moving average, a little bit above it. And it looks like maybe it's starting to tick up somewhat. Okay. So that's the implied volatility versus itself. We could also compare the implied volatility relative to the realized volatility. How does the stock actually move? Because the implied volatility is the market's forward-looking volatility. It's what the market anticipates volatility going forward. Right, that's implied volatility, and it's looking at, in this case, the next 30 days. We don't know what it will be the next 30 days, but as a reference, we could try to compare it to the last, let's say, 20 realized days of volatility, what the stock actually did. So it's 20 trading days. So 30 calendar days, roughly, you have like 20 trading days in there. So we could compare that to the last 20 realized days and see how much it diverged. Is the market anticipating higher or lower volatility, or right where it was in the last 20 days? Right. So, and if it's diverged, by how much? And to do that, we could overlay it with our next slide. So I'm going to take off the 20-day moving average of the implied vol. Click on that. And let's look at the 20-day moving average of the historical vol. So that's that purple line. Let me see if you could see better if I remove the options value. All right, so now we have these two lines here. The new purple line is the 20-day moving average realized volatility of the stock. The green line, that's the implied volatility that's derived from the option prices. Okay, so we could see here that if we come here all the way to the end, the current 30-day IV is pretty close to where the 20-day, the last 20-day realizes. It's a little bit above. So right now the market is anticipating a little bit higher volatility than we've seen in the last 20 days. And that, could be just, because there's always some uncertainty there, but it's pretty close. And here we could kind of see historically how far they even diverged, right? So that's not a big divergence between the previous 20 days and the forecast moving forward, because we've seen, higher gaps here. And these bigger gaps kind of make sense in these situations because you could see an earnings is coming up. So the implied volatility started to already price that in, right? So the previous 20 days realized volatility wouldn't have, the upcoming earnings. So we do see that there was some divergence right before earnings, and after earnings it kind of closes in. And at this time we don't see a very big gap between the two. So if you're anticipating much lower volatility or much higher volatility, then you could see that so far the market implied volatility market prices are anticipating something similar. And that's the 20-day. But we could smooth it out a little bit more. What if we took a longer term volatility instead? What about the 1-year vol? So if we smoothed out the average for 1 year, because volatility is considered a mean reverting statistic. So what if we looked at a 1-year volatility? So let's remove the 20-day. And what the 1 year do will smooth out those bigger implied volatility spikes up or down. All right, because if we had like one big spike up or down, it'll get smoothed out more as you average it out with more observations. And this historical moving average is for the last 252 realized trading days, realized volatility coming from the stock. So I'm going to click on that, and now you could see it more smoothed out, so it's not that we don't see as many spikes up and down, and we could see how far the implied volatility diverges from that mean. And we could see that a lot of it looks that it tends to trade it more often above the historical mean than below, even though here we did go below this mean. Okay, and keep in mind these are looking at two different metrics. One is coming from option prices, one is coming from the realized stock volatility. That's what we're comparing. Okay, and it seems like at this moment, well, let's take a look at a longer term. So this is 3-year. Maybe this is a little bit more balanced, where we had a while that the implied volatility looks like it traded below its longer term realized volatility, then started bouncing around above it. Now we're below it again. Okay, so that's a way to just compare the market anticipated volatility, forward-looking volatility, versus the long-term mean of the volatility in the stock. And you could see potential large divergence looking at a graph, right? And from a historical perspective, something like up here looks like a very large divergence. Around August 5th, we had a big one down here. And so that's above, and going below, you could just hover over and see by how much they diverged. And those are relative comparisons, right? So now we have the implied volatility. We talked about just looking at the implied volatility line versus itself. And then we could overlay it to get relative comparisons. Let's go back to the 1 year. And I'm going to uncheck this. So let's go back. We'll uncheck this. So how else can we compare the implied vol? Is it high? Is it low relative to something? Because when we're making an analytics, a lot of times analysis is based on a relative value, right? Is it high or low relative to what? Is it high or low relative to itself in its own historical or to its long-term mean? Or we could also add a different security in it. What if we wanted to compare the implied volatility of Nvidia to the implied volatility of an index, let's say, that is technology based, like the QQQ, right? QQQ, NASDAQ 100. How does Nvidia's implied volatility compare to the QQQ implied volatility? And how far apart are they now? And how far apart did they get historically? Are we, currently, are the implied volatilities diverging far apart, coming closer together? How does that look? Because that's one popular trade to do. Some people they do pairs trades with just stock, one stock against another stock, but you could also do the same thing with implied volatility. Trade implied volatility of one security versus the other security that you think have some relationship. So let's put in compare to QQQ. Type in QQQ here, NASDAQ 100. We're going to click plus. Now we got two lines here. The red line here, that's the QQQ 30-day implied volatility. The green line, that's the Nvidia 30-day implied volatility. So we see here that throughout history, consistently, Nvidia implied volatility is always above the QQQ implied volatility. They never crossed or touched. It's consistently trading higher than QQQ. Okay, so, and maybe makes sense because QQQ is an index with lots of diversified with lots of different stocks. Nvidia, it's exposed to firm specific risk, trades at a higher implied volatility. It also looks like we get, eyeballing it. We see sometimes, well, I'm looking over here that sometimes Nvidia's implied volatility starts to widen out, gets higher and then comes back in relative to the QQQ. And those could be instances where we do have earnings, because we did say that during earnings, implied volatility in Nvidia will increase due to that firm specific risk, the uncertainty, and then comes back in. But this gives us an idea here that how far apart we are now, which looks like, eyeballing it, looks like it's kind of in line here. It looks like it closed or narrowed a little bit and then started to widen back out. So that's another way we could start comparing it. If we wanted to add, for example, another symbol, we could just type in SPY and replace it with a different symbol. That's a relative value comparison. Okay. How else can we look at implied volatility? Let me close this. And I did forget to come down here. Below this is a stock chart of Nvidia. And what this will let us do is also just see how the implied volatility behaved relative to what the stock price did over time. Okay. So this is, again, another relative comparison with stock trend versus implied volatility trends. Now, there's another tab here, and it's called the IV term structure. So let's click on that. And what this does is now allow us to look at certain other implied volatility benchmarks. We talked about the IV 30-day constant maturity. Well, this now includes the IV 60, the constant maturity for 60 days, IV 90 days, and 120 days. And this lets us look at the implied volatilities of different maturities, different, expirations, let's say, in Nvidia, starting from 30 to 60, 90, 120, the longer dated ones. And we could see how they're moving relative to each other, because the 30-day and 60-day don't have to be the same implied volatility. They could be different, and they could move apart as well. So let's just say we wanted to look at 30 versus 60, could uncheck the 90, could uncheck the 120. Now we have these two charts. The green one is the 30-day. The red one is the 60-day. And we see that they do cross each other. Sometimes the 60 days above the 30, sometimes the 60 days below the 30. And sometimes they grow wider apart, like over here. A lot of times they're closer together. Right now, they're closer together, and it happens that the 60-day one that's a little bit further out, let's say the 2 months option, is trading at a higher implied volatility than the 1 month 30-day option, meaning that right now, as we go out further in time, from 30 to 60, markets are anticipating volatility to start increasing. Okay. And that's what this chart is showing. If we wanted to look at 30-day versus 120, let's say even longer term, we'll uncheck the 60, put in the 120, and now we could see that the 120 doesn't look like it bounces around as much as the 30, which makes sense. The shorter term options, the implied volatility, Vega's, it's more sensitive, so you have larger swings. But this also shows us that they'll crisscross. Sometimes the 30 days above the 120, sometimes it's below. There are certain periods where it got wider. A lot of times they're closer together, but certainly there are times that they diverged from each other. And this gives us a look back how they behaved versus each other and what it looks like right now, which is over here at the end. There's another real quick tab where it shows us the difference. So if I click on the difference over here, and let's say we want to see the 60-day minus 130, 90, 130, or 120, 130. So I'm going to uncheck these. And this is IV60 minus the IV30. So if we took the 60-day implied volatility and subtract it from the IV30, if we get a positive number, that means 60 days above. If we get a negative number, that means the 60-day implied volatility is below the 30, because 60 minus 30, right? So here, this lets us know that right now, IV60 is 2.3, implied volatility clicks above the IV30. And this just allows us to look at it through one line to see the difference, right? How much, and we could see even some of the peak difference, as much as 10 clicks up here, as much as like more than 10 clicks down here. So they could diverge by as much historically as 10 vol clicks, right? The 60-day volatility, we've seen at 10 vol clicks higher and 10 vol clicks lower than the 30-day. So those were the high ranges, and right now we're around 2, which seems like in the mid range. So I'm going to stop right there, Will. I think we kind of covered a lot with these implied volatility charts today, and those are the different insights we could get. Implied volatility.
Yeah, that's great, D. We did have one question from Stefan, who was asking about tracking IV. Let me try to get to it. Is there a way to track? Presumably your calculation put call interpolation. I see the option chain as both call and put IV for the strike. All right, I can't find it now. There were so many things in the chat, but he was asking about tracking the IV. Is there a way to track it? But I guess that that's what the charts are doing, is tracking the
That
IV.
is what, yeah, that's what the chart is doing. Right?
Yeah.
Tracking.
Well, Stephen, if you have a more in-depth question or I'm missing it, just let us know and we'll get to it. We'll be back. Are we going to be back tomorrow? The exchange
Tomorrow
is
close, so the day after.
So we're going to be back Thursday and Friday at the end of the week.
Yep. All right, everyone. And
what's that?
No, were you going to say something? Go ahead.
Yeah, the other thing is, I think it was the 9th. The exchanges may be closed for President Carter's viewing
right.
in the state capitol, right?
Right. So we'll be off that day too.
So everyone should be aware of that when they're looking at the options, that it will be an exchange holiday that day. So there you go, D. Great job. Great year, everyone. Right. Thanks for joining us and being members of the Chameleon community for the last year. And let's all have a great end of the year and a great start to 2025. Great job, D.
Thanks, Will. Thanks, everyone. Happy New Year. Stay safe out there. Have a great trading day, and hope to see you guys in the start of the next new year.
In the new year, trade in peace, everyone. Have a great day and a great New Year's Eve. And are you going to watch the last thing is the Penn State game tonight? You watching it?
Yeah, I'm going to start watching it. I don't know how much my wife will let me, if she'll let me watch the whole thing, but I'm gonna put it on at the start.
Yeah, well,
in the background.
With my daughter, a student there now, she's super excited, so it makes it more exciting.